What is worse, recession or inflation? Hi, and welcome back. On this episode, taking a look at what the next outcome is going to be here economically. Are we talking about a recession or continued high inflation? One can kind of cause the other, but let's break it down a bit here, Ryan. I think right off the top, as we touched on before, as it's pretty hard not to know, inflation hit a 30-year high here in May, hitting 6.8%. And the reality is, based on what's going on the streets, this looks to continue its upward trend, at least for the foreseeable future. Bank of Canada meeting on June 1st, and with this 30-year high, I think it's all but galvanized what is wildly expected to be a 50-point basis hike. This is going to be 3 hikes in a row, 1.25 points total. We're now going to be at a 1.5% overnight rate. The highest we've seen here in I think 7 years. And the reality is these hikes look to continue until Canadians fear a recession more than inflation. Bank of Canada's mandate right now, at least appears to be, is fighting that inflation. But again, at what point is it going to be fighting a recession? And at what point is it going to be elevating housing again?
I feel like the Bank of Canada's job is only to fight inflation. Like they shouldn't really have too many other mandates that supersede inflation. And I get where they're maybe going in with this direction in terms of putting the fear of God into people in the economy, but generally speaking, I mean, it's these massive 0.5% basis hikes that we're getting that are going to be sort of these big psychological punches for people, right? It's going to change their sentiment. I think creeping with 0.25, 0.25, 0.25, as much as I would have preferred that, wouldn't have changed the sentiment in the same way. So, I'm not saying I necessarily agree with what they're doing. They have to do this. They have no choice. They've created this situation. But at the end of the day, I tend to agree with your last comment that I think the hikes will continue until the psychological impact is greater than the actual problems we're facing.
At this point, it almost seems like the mandate is to react late and overreact when they do, because it seems to happen every time.
Yeah, it's
But
knee jerking.
yeah, exactly. And like you said, confidence, it's waning for sure. And when you look at the key indexes or key indicators rather of a recession, it's just, that's a big one, right? Is that consumer confidence goes down, that you're in a high interest rate environment. Are we high now? Subjective term, higher than it was a year ago, but definitely not high compared to the 30-year average. But of course, we've also got, a strong employment market, but with inflation this high, we're seeing wage rates decreasing. They're
Yeah,
increasing, but not against inflation. Excuse me. So those 3 indicators right there basically can create a recession on their own. So we're kind of right on the verge here.
yeah. I mean, I don't think people, especially young people, probably don't. Um, what's the word I'm looking for? They don't respect inflation as maybe the problem it can really turn into, right? And so I think, you know, there's also a fairly large massive transfer of wealth taking place too. And while we are seeing, all of these job openings and people are or companies are paying more for people, we're still not getting those people into jobs. And I don't know if that's because of what's happened over the last 2 years, if people working from home has changed their perspective a lot, if they want a better balance in their life. But um, you know, even with these new jobs, if inflation continues to carry up, wage increases over the last couple of years have averaged about 3.5%, which is fabulous in any other world. But when inflation's running at 7, you're net minus 3.5%, right? So to me, they're the desire to go to work is not really in your benefit as long as inflation remains at the pace it's at.
Yeah, and that's going to obviously, as we know, affect housing incredibly too. And so rising
Yeah.
rates are one of the biggest driving factors of prices. And the thing that's happened most recently and most impactfully is that in just the last 6 months alone here, the rate of appreciating homes, along with the rate of increasing interest rates, has made the average mortgage payment increase by $800 in just, as I mentioned, 6 months. That is, that's not something that
Absurd.
people easily swallow. And I mean, you look at how long it took the last time for it to increase by $800, 6 years.
Wow.
So the same growth that's happened over 6 years just doubled and happened again in 6 months. Okay,
What
you can't not feel that something has to break.
it's kind of like we talked about on our pod last week, where it's not so much the numbers that are crazy in this respect, it's the volatility and the pace at which the numbers are doing these things, right? That's what's creating a bit of the shock, in my opinion. It's this, okay, payments have increased before by $800, but like you said, it took 6 years, not 6 months, right? That's a big problem, in my opinion. And um, further to kind of your comments earlier, I think like you know it what's the word I'm looking for here? The interest rate that we're dealing with here across 30-year averages isn't high, but the price point for real estate is at all-time highs. So in the real estate market, while the interest rate is at a bearable number, the purchase prices and the servicing of those mortgages are not. And that is really causing a problem that I don't want to say we've never really seen before, but the pace at which the problem is getting created is something that we've probably never really seen before.
I think the term "what goes up must come down" kind of comes into play here. And, in real estate, yes, that's a cycle. But again, when something happens that quick, it's natural that the opposite happens almost equally as quick. And
Yeah, it's
so
unsustainable.
let's look at some of these ramifications that have happened in just the last month due to this overly rapid acceleration here. I mean, Ontario, in April, it saw a 6% price decrease in April for
Holy
the HPI.
cow.
And the HPI is
Holy
your smoothed
cow.
over lagging indicator. So that's a
That's
huge
a
drop.
big number. That's
And,
a really big number.
yeah, I think May is going to be pretty on par with that too, which is going to be a shock to the whole system, of course. And um, locally here, I mean, GVRD, we're looking at right now the average and median in May down, each of those are down about 5% for the month.
Mm-hmm.
So
Mm-hmm.
HPI is going to smooth that over. It might be down 1%, maybe 2
Maybe
for the
two.
month, but still, I
Mm-hmm.
mean, to see that happen in Ontario is staggering, really. I mean, they saw it go up the quickest. No surprise, it's coming down the quickest.
Yeah, for sure. Now, Ontario also grew by like 40%, 50% over the last 2 years, right? So a pullback of, HPI being 6, but the real number probably more like 8 to 10. Um, you know, I think that this is probably going to continue for some time. I don't think it's going to continue at 6% a month, but if it does, the equity growth over those last 2 years is definitely going to get chewed into. However, I still think you'll probably end up being better off than you were, even at the end of this, had you not bought.
I will agree. I will agree. And this is just history repeating itself. Every time
Yeah.
there is a downward cycle, a correction, whatever you want to call it, those that hold come out ahead. And,
Mm-hmm.
and often in a pretty quick time frame. We've seen global financial crisis. It took all of 12 months to regain all the losses then, and hey, you're up 75% since. So there's
Mm-hmm.
an example of the recent cycle. Um,
Yeah.
but again, like let's touch a bit more here on the extremeness of everything that's going on here. So again, we for the last year and a half, 2 years, have basically been saying, oh, new all-time high, new record, new record, new record. And this
Mm-hmm.
is across essentially every metric that exists. Now, it's going the other way. So we just saw the first decrease in Canadian HPI price last month in April, dating back to April of 2020. And of course, that was because of the lockdown. So it's, take that metric for what it is, a little bit of a very different month. But hey, now it's a more normal month. And yeah, we've seen a first price decrease in a couple of years here. And This is based largely, of course, on volume. All right, sales in Canada down almost 13% last month, and this is the steepest monthly decline since the stress test was implemented in 2018. I am taking out the April 2020 lockdown month, weird metric, but again, that's a 4-year high in decline rate that we're seeing last month.
Which generally speaking, I would be kind of against that. But what's happened in those last 4 years? We need a decline. We need an adjustment here. I mean, we always talk about declines being a bad thing, but for the overall health of any market, they need to take place. Things just can't go up, right? I mean, it's not great news if you own real estate, but it is fantastic news if you're trying to buy real estate, right? And so let's also remember there's two sides to this market, right? There's the buyers and the sellers. And the buyers, if you're sitting on the sideline or you've been waiting, this is your time. And like Dan just said, these times don't tend to last forever because everybody's attention is on them, right? So if it goes too low, the Bank of Canada starts to look terrible, politicians start to fear, and then we start to see movement come the other way. So you won't have a whole ton of time. You have to seize these moments. And yes, you're dealing with higher interest rates and you're dealing with higher mortgages, but at the same time, maybe don't get a 5-year fixed rate right now, right? Get maybe a 2-year or a 3-year, or go variable, right? Because there's a lot of wobbling taking place right now.
One of the biggest tips I picked up as a member of the Real Estate Investment Network is try to align your mortgage term with the U.S. presidential election year. Why? Because historically, interest rates go down during a presidential election year. They're trying to look good. They're trying to make change. They're trying to make people vote for them again or for the first time. So there you go. Little pro tip there. Okay, a little bit more intel here then on Ontario, because we really do like to see what's happening on the other side of our country because it does reflect what happens on our side. And in the last 2 months, sales are down 30%, which equals the steepest decline dating back to the global financial crisis in 2008. We're referencing the GFC quite a bit lately. Can we see history repeating itself again? Yes, I think there's a lot of metrics that are similar. And again, when the data's saying, okay, yeah, we're experiencing a housing market that's acting just the same way it did, or is at least starting to back in the global financial crisis, you kind of know what to expect. Well, what was that outcome here? Housing dropped 12% in the HPI over 8 months. And like I said, it took 12 months to fully recover. So will we see that exact again? No, but there's a pretty strong reference. When prices did hit that 12%, what did we see? Stimulating. We saw rates drop. We saw extension in AMs, etc. So little insight into what might be happening in the upcoming months here.
And at least at a top level, I mean, inflation comments aside, I don't know if they can be aside, but the global financial crisis, I think was probably a worse set of circumstances than where we are now. So I don't think, it's hard to say if there's a bunch of stuff that hasn't been uncovered, but the global financial crisis had a ton of other issues too. But generally speaking, I think this is going to be more interest rate related because of inflation, primarily, right? And the issues that we had around our housing market haven't gone away. The demand, the immigration levels, the chronic undersupply, those issues haven't changed at all, right? So as soon as inflation calms down and as soon as interest rates calm down, we're going back to the same issues we had before, right? What we have now is a different problem to tackle, and all the other ones we've just booted further down the line, as we so often do. So, my long-term look on real estate is still very bullish. It's just there's some short-run pain here that we've got to deal with as a result of keeping our economy alive through the pandemic, and then not reacting quick enough when it actually responded.
Perfectly said. Totally agree.
Yeah.
That was spot on, and you're right. I mean, let's look at some of these underlying issues. Yeah, sure, inventory is increasing really quick right now, but coming off of such a low baseline.
Yeah.
I mean,
Yeah.
you look at Canadian inventory as a whole. It bottomed about 4 months ago at about 90,000 active units across the entire
Crazy low.
country.
Yeah. Crazy.
We're up about up about 15,000, let's say, about 105,000 active units today. And yeah, here we go, another record, fastest since 2010. But let's remember, we're at 105,000 active listings today. It was only 2015, 7 years ago, when that was at 250,000.
Yeah. Yeah. And that was also quite a time. There was a lot of bullishness in the market at that time too. So, and we had the supply to feed some of that demand anyways. But, again, at 105,000, we're just so low, comparatively speaking, to the amount of people coming in, to the industry that we're trying to serve, and to the growing families that exist here. That issue's not going away, right? I'd be amazed if we get back to 250,000. I don't know. I don't know if that's going to happen, but not anytime soon.
Yeah, I mean, 15,000 over 4 months, you'd have to multiply that over another 30 months to maybe get there.
Yeah. So yeah. And I doubt I doubt we're going to see interest rates go up for 30 months. Right. So I don't know. We'll see. It's interesting time, but the problems that existed before are still very much present.
Yeah, there's one metric, there's one outlier here that is very curious. And this is one I want everyone to really listen to because we haven't seen it before ever. Low inventory very typically means increasing prices. So for the first time ever, since the data has been collected, we saw a price drop with low inventory. This was obviously last month. So you look at Canada, down 0.7% in price, but with 2.2 months of inventory. You have to go all the way up to the same chart showing 5+ months of inventory for prices to drop. That is quite a significant outlier. Again, we're coming out of quite a significant couple of years. Everything's different, but again, it's just never happened before. So it's something that we're paying close attention to.
Yeah, and you need a bit of time to understand if that's going to persist, right? Is it an outlier or is it truly something that we need to pay attention to? Because if it's an outlier and in a month we're back to where we were, because people tend to pause when major changes take place. However, if things get worse, and it sounds like in terms of lending, mortgages follow the flow of capital. If we restrict the flow of capital and people can't buy, even with inventory so low, they may choose not to buy, right? That's where there may be some difference here in terms of preference and sentiment because of the environment that we're in. But again, I think we need more of a trend to really see if this is something that is going to be alarming or not.
Yeah, no, of course, but definitely an interesting one. Next month,
Yeah.
I'm predicting it to be pretty similar. It's going to be a little bit more inventory, but another price drop. And again, here it's going to be two metrics now side by side, starting to create a trend.
Very much
but,
so.
of course, where we are in 6 months might be radically different.
Yeah.
Meanwhile, though, in the background, there are homes being built, so this extreme low inventory scenario that we've been in for 6-7 years now, they are trying to rectify it, where new home construction went up 2% in April. And again, we're talking nationally here. And it's an all-time high right now. Led the way by condos, followed by purpose-built rentals to the tune of about 250,000 homes right now are under construction.
I think that's good. I mean, we need that, we've got some climbing inventory, but I think, again, we need to create a more sustainable environment, not something that is, some indicators look better over here than others, right? It's like we need a more holistic approach. and again, this has been decades in the making to arrive at the situation we're in, right? So it's not something that we're going to fix overnight, but we sure as hell need more condos and especially if we're continuing to bring, close to 500,000 people here a year, right? These are welcome numbers.
They are, and yeah, even with 250,000 under construction, the amount of unsold inventory from pre-sales, it's actually sitting at an all-time low right now.
Holy
Something
cow.
about 7,000 right now, unsold units across Canada. Um, that ties the all-time low that we saw back in 2002. But again, you got to think it was only the beginning of 2020, so just over 2 years ago, that number was 17,000.
Wow.
So
Wow.
they got bought up very quickly in the last couple of years here, and these new homes, essentially, looking at this metric, can't come quick enough.
Well, interesting, because I kind of want to tie this metric to the one we just talked about, not the ones under construction, but the price dropping with the level of inventory also as low as it is. And yet we look at the pre-sale market and we see it red hot with next to no inventory. And my thinking behind that is all of this interest rate movement, all of the cost of capital right now is getting affected to the point where if you're buying a pre-sale, all you need is some capital to tie up that investment. And you don't need a mortgage for the next 2 or 3, maybe even 4 years. So if anything, if you're an investor, this could almost be a better investment because you're not going to have to pay mortgage rates in the short run that are expensive versus not paying any. Right. So I wonder if, there's a big flocking towards pre-sale right now as a result of higher interest rates.
Right now, possibly, yeah. I mean, you got to think they always tend to follow the resale market, which is red hot for 2 years and lags. And
Mm.
so now that resale's falling off, will pre-sale? Most likely, but you're right.
Yeah.
There's going to be people that will look at it and be like, okay, I can lock in today if it's a 3 less year build, or I could roll the dice a bit and say, look, I think it's going to be cheaper when it's completed.
Yeah.
Again, be careful with that, and we can
Totally.
obviously advise accordingly based on your situation. But for sure, we know people definitely play the odds there.
At the same time, Dan, just last comment. I also wonder if, this is also the result of such staggeringly low inventory over the last bunch of months. Like you said,
Hmm.
it's a lagging indicator. So, have a lot of these units then been consumed or purchased as a result of having no inventory or the inventory that was available being no good. Right. So it's probably a function of those two things. But anyhow, interesting metrics nonetheless.
Well, and also people that over the last 2 years were so sick of competing and
Yeah.
losing, they're
Yeah.
like, well, look, I just got to buy something,
Yeah. I want to get
which
in.
was the case. And if you could potentially walk into a pre-sale presentation center and buy a home without competing. Yeah, sure,
Yeah.
you're not moving in for 4 years, but for some people that was okay.
Yeah.
And you know who else might be buying these right now too, Ryan, is the new immigrants,
Mm-hmm.
because they are looking at something that's going to be completed in 4 years. And again, rolling the dice a bit here, but if they're told or expecting to get their PR within 2 years, 3 years, um,
Or less.
they could look at that option. Because
Mm-hmm.
as you touched on, immigration, when the government puts their mind to something, apparently they can accomplish it. Because here we go, they've got record targets and they're hitting them.
Yeah.
January, February, March of 2022, every month saw the highest amount of PRs ever given ever for each
Wow.
month. So
Wow.
that gives
Yeah.
you a sense of the rate of immigration in this country right now is
Yeah.
all
Don't
time
think
highs,
demand's
month over month over month.
don't think demand's going anywhere, right? I mean, these people are getting their PRs, they're landed immigrants now. They're here to stay, right? As they continue to learn about the areas that they're living in, they'll choose to buy at some point, right? So, at least a lot of the professional people who are coming here for work, that tends to be what we see.
Yeah, and so I think no surprise with record amounts of people coming into the country and houses as expensive as they are, the rental market has taken off again.
Mm-hmm.
So much so that the lease to list ratio that is recorded in Toronto for anyway, a 7 year high. More demand for rentals than in the last 7 years right now today. And you
Wow.
know what that does to prices.
Yeah.
So here we go.
Well,
We have in flow, right? Okay, resale's too hot. Well, then go into rental market. All of a sudden, your rent gets so high, you might as well buy a mortgage because resale came down. And the tug of war and the cycle continues.
Well, and to your point, I mean, the rental market booming. So now, the new mortgage demand is still running hot at 11% year over year, right? Um, Looks to have peaked in about mid 2021. It's been kind of level ever since, but still very strong, right? Still very strong. And so, I've got a number of clients right now who have sold property in the last year, have rented something short term, and intend to buy something within the next year. So I don't actually. This isn't surprising, but the mortgage demand to me still running hot with it being at the interest rate levels that we're seeing. I mean, demand and the necessity is, I mean, the rates are still not high comparatively speaking, historically speaking, I should say. But comparatively speaking to 2 years ago, yeah, they're much higher. But again, I'll be surprised if we see those again in a long time, right?
Yeah, place your bids now as to when the next rate reduction is coming.
Yeah.
It might be sooner than most think. Lots of increases to happen prior. Well, lots. We don't know if it's lots. It's going to feel like lots. A 0.5 will feel like a lot,
Mm-hmm.
but it's we're what mortgages across the board. The major lenders are all 4% plus right now. That's already pretty much baked in the June 1st announcement, but are they going to
Yeah.
continue to creep up after that? Most likely.
Yeah.
So it's going to get a bit harder. And let's think here on a bit of that positive note. We've still got credit card delinquencies and consumer insolvencies at all-time low, but I think we are right now experiencing sort of that bottom. I think, as all these savings from the last 2 years are getting eroded away with inflation, with increasing rates, this is probably the end of those good times, if you want to frame it that way.
Yeah. I tend to agree. Yeah. I mean, we're going into a tightening sort of environment, right? So, in a tightening environment, when you don't have, free flow of capital to pay off these things, then debt will mount, and that's bad debt, FYI. That's not good debt, right? So you don't want bad debt to mount.
Ever.
No.
Okay, so here we go. We've got records going the other way, downwards right now. We've got some outlier data that's coming in. It was interesting on the way up. It's gonna be interesting on the way down. We're gonna keep you very informed here. Ryan, anything you want to share to wrap this one up?
Really, at the end of the day, guys, this is in our opinion, at least in mine, it's short-term pain. The market is correcting, right? Without a doubt, the market is correcting, and it needs to correct. Also, this is again why we buy real estate for more than 2 or 3 years. We buy real estate and we hold real estate. We don't buy it and flip it and panic sell, right? This is cyclical nature of things. Yes, for every action, there's an equal and opposite reaction. The question is once prices continue to come down, when will we flick around the switch and start going the other way, right? Is that in 6 months or is that in 12 months? It likely won't be much longer than that.
Great place to end it. Thanks as always for watching and listening. What are you doing with your housing? Let us know. Give us a call, give us an email. We'd love to chat and just give your portfolio or your home or your plans a review and share what we think is best for you and your family. Thanks as always for watching and listening, and we will see you next week.